Good day, everyone. For today, I will be discussing with you cash and cash equivalents. So after studying this topic, the students should be able to describe the nature and measurement of cash and cash equivalents, to identify items classified as cash and cash equivalents, to account for petty cash fund, and to prepare a bank reconciliation. So let's first understand the concept of cash. So in layman's term, when we say cash, it means money. However, in accounting parlance, it does not only include money. So it includes money and other negotiable instruments such as checks, money order, and bank drafts. When we say money order, this is a prepaid paper allowing the stated payee to receive cash. So it's usually issued by government through postal offices. So for bank drafts, these are drawn against the depositor's account and set aside in a temporary hold until it is cashed. So to understand more about bank drafts, I'll give you a situation. So for example, Mr. A wants to buy a car. So we know that car is somehow expensive and it is unusual to pay for it in cold cash. So in this case, Mr. A may issue a check as payment. However, on the part of the seller, there is no assurance that the check will not bounce. The seller may require Mr. A to pay instead using a bank draft. So how does it work? Mr. A will go to the bank where he has a bank account. He will request a bank draft for the amount equal to the price of the car. The bank will then hold the funds from his bank account in exchange for the draft. So Mr. A can now buy his car and the seller will now have an assurance that he will be paid because the draft was guaranteed by the bank. And for an item to be classified as cash, it should be unrestricted in use. So what are the items classified as cash? So I've enumerated 4 items which will be discussed in the later slides. So first is coins and currency. So it includes bills. Second, bank deposits. Third, checks. And fourth, cash fund. For bank deposits, there are 3 types. First is the regular savings. Second, demand or current or checking account. Third is term or time deposit. So let's differentiate the 3. So the first point of difference is as to purpose. Of course, for regular savings, the purpose is to save money. For demand deposit, for spending. And for term or time deposit, to grow money. Next point of difference is as to whether the deposit bears an interest or not. So for regular savings, it bears an interest. For demand, since it is used for spending, usually it does not bear interest. It may bear interest, but the rate is lower than regular savings. And for time deposit, since the purpose of it is to grow money, it has a higher interest rate than regular savings. Okay, so the third point of difference is as to evidence. Okay, so where can you see the balance of the deposit account? So for regular savings, based on passbook. For demand deposit, based on checkbook. And for time deposit, based on certificate of deposit. Okay, so as to withdrawal, so regular savings may require notice of withdrawal. Usually it applies to large amount of money. For demand deposit, okay, from the name of the deposit, demand, it is withdrawable on demand by throwing checks. And for time deposit, it has a preset date of maturity. So usually it is the term of time deposit is 5 years, 10 years, okay. And if it is terminated before its maturity date, there may be penalty assessed. Okay. So it includes charges and also the interest income may be subject to taxes. Okay. So here comes the accounting treatment for these bank deposits. For the classification, for regular savings, it is classified as cash. For demand deposit also is classified as cash. And for time deposit, it may be classified as cash equivalent. So it may never be classified as cash. Okay? There may be instance that a bank account has a negative balance. So in accounting, we call it as bank overdraft. So an overdraft is a negative bank balance resulting from issuance of checks in excess of deposits. So what's the accounting treatment for bank overdraft? So as a general rule, it is classified as current liability. However, there are exceptions to this rule. So the first exception is that it may be netted off against other bank account maintained with the same bank. Okay, so for example, the entity has two bank accounts maintained in Bank A. Okay, Bank 1, account number 1 and account number 2. Okay, so the first account has a negative balance. The second account has a positive balance. So instead of reporting the negative balance of account number 1 as current liability, it may be offset from the balance of the second account, as long as the second bank account is unrestricted. Okay? It may be also deducted from total cash and cash equivalent if it's repayable on demand and it forms integral part of the entity's cash management. So, how do we know if the banking arrangement forms integral part of the entity's cash management? So, according to IAS 7, if the bank balance often fluctuate from positive to negative, okay, then it can be said that it forms part, okay, of the integral part of the entity's cash management. Okay? So next is compensating balance. So what is compensating balance? So it is a minimum balance maintained in a bank account in order to guarantee future credit availability. What is the accounting treatment for compensating balance? So if it's legally restricted and the related loan is short term, it is classified as other current asset. Okay? Other current asset, not included as cash. Okay? If the related loan is long term, it's classified as non-current asset. So if it's not legally restricted, it is part of cash. So what if the problem is silent as to restriction of compensating balance? So if it is silent, it is assumed that the restriction, okay, is not legally restricted. Therefore, the compensating balance is part of cash. Okay? And also, the compensating balance must be disclosed in the notes. So we are already done with deposits. Now let's proceed to checks. So the first type of check is postdated check. So it is a check drawn and delivered to payee but dated subsequent to end of reporting period. Okay, so before I give an example, let's assume that in all of my examples, the end of reporting period is December 31. Okay? Okay, so I'll give you an example for a post-dated check. So let's say the check is drawn December 28 and it was also delivered that date. However, the date of the check is January 2. Okay, so the payee will not be able to encash that check until January 2. Okay. So, what will now be the treatment of post-dated check? What will be the accounting treatment? So, it depends if the post-dated check is a company check or a customer check. So, if it's a company check, it is restored to cash in bank. Okay, so take note, it is restored. So, meaning, upon drawing this check, it is already recorded as a disbursement. Okay. So, it will require an adjusting entry at the end of the reporting period to restore the check to cash in bank. Okay? So, later I will explain why companies post-date check or draw checks in advance. Okay? So if it's a customer check, the receivable is again set up. Because upon receipt of the post-dated check, it is recorded as debit, cash, and credit to accounts receivable. However, the company cannot encash yet the check because it is post-dated. Okay? So it will be restored to receivable. So the next type of check is undelivered check. So an undelivered or unreleased check is a check drawn and recorded but not yet released to pay on or before the end of reporting period. So for example, the check is drawn on December 28 and also recorded on that date, but as at December 31, it's not yet released to the payee. Okay, so we assume here that this undelivered check is not post-dated check. Okay. So what's the treatment of undelivered check? So it is restored to cash in bank. Of course, the check is not yet delivered to the payee. So how can the payee encash the check? Okay. Next is certified check. So it is a check drawn by the depositor for which the issuing bank guarantees that there will be enough cash available in the depositor's account. So since it was already guaranteed by the bank, even if it's not yet in cash by the payee, it is no longer part of the cash. Okay. Next type of check is stale check. So a stale check is a check not encashed within 6 months. Okay. So 6 months is based on the current banking practice. So what will be the treatment of stale check? So it is restored to cash. So if it's material, set up again the liability account. Okay, so it's in the point of view of the company here. The company is the one, no, who issued the check. So if it's immaterial, just credit it to miscellaneous income. The next type of check is similar to bank draft. Okay, so it's a manager or cashier's check. So it is drawn against bank's funds and issued to the depositor after transferring the funds from the depositor's account to the bank. So why is it similar to bank draft? Because it's not an ordinary check. Okay, so an ordinary check might bounce. In this case, the issuer of the check is the bank. Okay, so manager's check or cashier's check is considered as cash. Next is traveler's check. So it is an alternative to hard currency, therefore, it is considered as cash. In the previous slides, I discussed post-dated check. Okay, so the treatment of post-dated company check is that it is restored to company's cash and bank. So for post-dated customers check, it is restored to receivable or the receivable account is again set up. So from that rule, it can be implied that upon receipt or upon issuance of the post-dated check, there is already a recording made by the company. Okay, so you're now wondering why is it that a post-dated customer check is recorded as collection upon receipt. So here are the reasons. The check might not be presented for encashment on time, or the company might also forget that the customer had already issued the check. So in simpler words, it's just for monitoring purposes. So why not make a separate record for post-dated checks? So it's impractical or it's not convenient to make a separate record for post-dated checks. So it's just better to record it as receipt, then adjust it at the end of the reporting period. You might be wondering why checks are drawn in advance. So a check is only issued when it is signed, and usually there are two signatories. Imagine the situation. A company has a bill from its supplier that needs to be paid today. What if at least one of the signatories are not around? The check will not be signed, and of course it will not be issued to the supplier. Thus, the bill will remain unpaid. Okay, so what about this? Why are post-dated and undelivered company checks recorded as deduction from cash-in bank balance upon drawing? So as I mentioned in the previous slides, the treatment of post-dated and undelivered company checks is that these are restored to cash-in bank. So from there, it can be implied that these checks were already recorded as disbursements upon drawing or upon issuance. So what's the reason for this? So let's read. In a voucher system, a business document called voucher is required to support every disbursement made by a company. The voucher lists the items to be paid for and the amount to be paid. Once the supporting documents are reviewed and the voucher is approved, a check will be made and drawn. And the supporting documents together with the voucher will be stamped as paid to avoid multiple payments. Okay, so I'd just like to highlight this phrase, to avoid multiple payments. So it's the very reason why post-dated and undelivered company checks are already recorded as disbursements upon drawing or issuance. So if the check drawn is not yet recorded, it is as if no check is made for the voucher. So the tendency is that the voucher will be again presented for payment. Okay? Next. So we're done with deposits and checks. Now, I'll discuss cash fund. Okay, so when we say cash fund, it is cash set aside for specific purpose. So if it's for regular use, meaning it is used for current operations, the fund is classified as cash. So example of this are petty cash fund, revolving fund, payroll fund, tax fund, dividend fund, and the like. Okay, so these funds are used for current operations. Okay. Next, if the fund is set aside to pay or to settle a liability, so what will be the classification of this? So it depends. If the liability, the related liability is due within 1 year as at balance sheet date, the fund is classified as cash. If due beyond 1 year as at balance sheet date, it is classified as non-current asset. So it's not classified as cash. Okay, so to summarize this rule, the classification of the fund should parallel the classification of the liability. So if the liability is current, the fund should be current. So it is classified as cash. If the liability is non-current, the fund is also non-current. Okay? What if the fund is set aside to acquire a non-current asset? So the fund is always classified as non-current asset, regardless of the year of use of the fund. So even if the fund will be used next year, the fund is still classified as non-current asset, meaning it's not part of cash. So let's review the topics by answering some questions. Okay, so the first question is, all of the following can be classified as cash except letter A, currency and coins, B, time deposit, C, checking account balance, and D, post-dated check. Okay, so in answering multiple choice questions, you must choose the best answer. There may be at least two correct answers, so choose the best answer among them. Okay? So if your answer here is letter D, maybe you did not read carefully the question. So it says here that which of the following is not considered as cash. Okay? So letter A and letter C are definitely classified as cash. Okay, so we have eliminated those two choices. Okay? So let's review letter B and letter D. So which of the following, which of the two is not classified as cash? Is it time deposit or post-dated check? Time deposit cannot be classified as cash. The time deposit is never classified as cash. It may be classified as cash equivalent. Post-dated check may be classified as cash if the post-dated check is a company check. Okay, so the better answer here is letter B. Okay? So let's proceed to the next question. Bank overdrafts that cannot be offset should be letter A, reported as a deduction from cash and cash equivalents. Letter B, only be disclosed. Letter C, reported as a current liability. Letter D, reported as a deduction from the current asset section. Okay, so choice D here is not the correct answer, obviously, because there's no such rule. So, since the back overdraft cannot be offset, it may not be also reported as a deduction from cash and cash equivalents. Okay, so it's between B or C. In B, yes, it is disclosed, but it says here that only be disclosed. So meaning it's the only accounting treatment for bank overdraft. Okay, so the answer here is letter C. It's reported as a current liability. Next question. Deposit held as compensating balance. If legally restricted as to withdrawal and held against short-term credit is part of cash. Letter B, if legally restricted as to withdrawal and held against long-term credit is part of cash. Letter C, if not legally restricted as to withdrawal and held against short-term credit is part of cash. And letter D is legally restricted as to withdrawal if the problem is silent as to restriction. Okay, so choices A, B, and D are similar as to the restriction. Okay, so the compensating balance here is legally restricted, and we know that if the compensating balance is legally restricted as to withdrawal, it's no longer part of cash. Okay, so A and letter B are not the correct answers. Okay, so which of the two remaining choices is the correct answer? Okay, so let's check letter D. So if the problem is silent as to the restriction, it is legally restricted. Okay, so what's the rule? If it is silent, the restriction is not legal. Okay, so the best answer here is, and the only correct answer is letter C. Okay, so if it's not legally restricted, it is part of cash. Okay guys, just an advice. In answering multiple choice questions, it's not enough that you only know the reason of the correct answer. You should also know why the other choices are incorrect.